Costco Wholesale Corporation, ticker symbol COST, is currently trading at $951.09 a share. Already down 1.5% today, and over the last 5 days, it is down around 8%. The reason for this market sell-off, we've had news of tariffs and uncertainty, and Costco is getting a little bit hit harder than the S&P 500 if we look at a similar time period, as that is only down around about 1% over the last 5 days, whereas Costco is down about 10. So yes, this stock is getting hammered more than others. Is this a buying opportunity? That is the question I'm going to be answering today. So let's have a look at my automated stock valuation spreadsheet. If we put in the ticker COST, this will load up all the latest company financial data so we can have a deeper dive. If you're interested in this, check my Patreon. It is the $4 tier, but let's continue. So as I said before, $957 a share. Obviously that price has changed, down 1% a day. 430 billion market cap, a PE ratio of 55, which is a lot higher than the market average. It's currently dropped to around about 28.84. Previously it was about 30, but it's decreased since then. Earnings per share $7.13, a beta of 0.82, meaning it is surprisingly less volatile than the market despite its current price fluctuations. And analysts do say it is a buy with a target price of $1,062. If we were to go historically, it was previously at that price just a few weeks ago. Dividend, it does pay a dividend, 0.48%, meaning you'll get paid $4.59 a share. And obviously this is a very safe dividend as they pay around $2 billion. In terms of the net income, about 26%, and free cash flow payout ratio 40. Buy before the 7th of May if you want to get paid your quarterly dividend. So looking at revenue, trailing 12 months, all-time highs, 258 billion, almost 259. And you can see they have consistently grown their revenues year over year, and specifically over the last few years since a little thing happened in 2020. Are they able to generate more profit out of that? And yes, they are. 7.58 billion trailing 12 months, all-time high. Once again, 15% year compound annual growth rate. Yes, very, very increasing their margins. Free cash flow is a similar story, not so much, 5 billion, down from 2024 and 23, which was their all-time highs. If we look at operating cash flow versus CapEx, you can see CapEx is consistently increasing, but operating cash flow is down, which is why obviously the free cash flow is down as well. Shares outstanding, they've been flat, basically going back to 2013. So they're not issuing more shares and not buying back shares, but they have remained flat. So let's have a look at the discounted free cash flow model. This is the way of valuing stocks, looking at future free cash flows and discounting them to today's value. Let me just put the average numbers in here. And we will say that it gives us a price of 366. Let me just make this full screen again. $366 a share. Let's see if we agree with that. Now, obviously, the free cash flow ratio is very high, 84 of the prior year and 76 of the years prior. So I don't think discounted free cash flow model like the stock, but let's just have a deeper dive. 272 and 286 billion. Let's see what analysts are expecting in terms of revenue. 273, 292, so a little bit more bullish there. Let's just see what they say in terms of growth rate. 11%, so slightly less than the S&P 500. So they are expecting increasing growth. So let's just be a little bit more bullish here, just for argument's sake. 6%, $375. Net income margins, they are increasing. Let's see if they could increase that at 3%, 415. And finally, yeah, so if we take an average of these last few years, even then 87%, even if we are at 100%, which they've only historically been in a couple of years, it would still be less than $500 a share. So discount free cash flow model does not really like this stock, but as I said before, it has very, very high ratios. Dividend discount model, let's just see what it says here. Now they do grow quite high, so about 13%. Obviously that is lower than the weighted average cost of capital. So realistically, yeah, I mean, dividend discount model, and probably doesn't say it's a buy, but it is a very low dividend. Basically, they need to keep on increasing their dividend at the rate they are, probably be close to be fairly valued. So not a good measurement for something with this small. Venn Graham formula for intrinsic value. P of a no-growth company, earnings per share, AAA bond yield, corporate bond yield. They're the factors that we're looking at. As we said before, the expected growth rate of Costco is around about 13%, I believe we saw. No, my mistake, 11. If I put in 11%, gives us $300 a share less than that. And obviously the bond yield very high at the minute, 5.32. it would need to be way, way lower for this to be a buy on this. So discount free cash flow model doesn't like it. Ben Graham model doesn't like it. It was about $300 a share. Dividend discount model doesn't really like it either. So the final one I look at is the comparable company model. This is the way valuing stocks, looking at their competitors. We're looking at revenues, revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, Peter Lynch's price to earnings growth. But then the specific metrics that are in the model are EV to revenue, EV to EBITDA, PE, and forward PE. WMT, Walmart, if I don't put the hash in there, WMT, Walmart, we'll do one of them. We'll do Target, and we'll also put BJ Wholesale Club Holdings. If not, we'll look at Kroger as well. We'll also compare against Amazon if time allows. So we'll just let these load in. As I said before, if you're interested, please check out my Patreon. It's a $4 tier. This gives you access to the sheet, all of its data, and as long as you're a paying Patreon member, you can keep on using it. So enterprise value, Walmart is the largest, then Costco, second highest, Target and BJ is a lot smaller. Revenue, second highest. Revenue growth rate, interestingly, and this is probably why it's a good buy, the revenue growth rate for Costco is actually the highest of all these, despite even Target and BJ's being a lot smaller. EBITDA, second highest. Net income, second highest margins, and they are increasing, which is good. Price to sales, market average is around about 3, but you can see all of these are below that, but Costco is the highest out of these. Price to book, market average is about 5, is the highest again. Price to earnings growth, highest by a lot. Ideally, you want this under 1, but you can see here none of these are, and Costco is a 5. So EV to revenue, it is the highest. EV to EBITDA is the highest. PE is the highest. Forward PE is the highest. Ignore the green there. Puts it at about $600 a share, probably closer to $570. So none of the models say it is a buy. It is a bit overvalued at the minute. Just for comparison, let's just add Amazon AMZN, and we'll just compare it against these two specifically now. Now, obviously, let me just override the sheet here. Now, obviously, Amazon is not a direct competitor because obviously they have a massive amount of their profit and revenue is from the AWS side, but let's just have a look here. So EV to revenue, we're just loading Amazon there. EV to revenue, Amazon's a lot higher. EV to EBITDA, a lot lower. PE lower. So it does bring the price up a little bit. You can see on the EV to revenue side, but as I said before, this is a little bit different. So none of the models, interestingly, saying it is a buy or saying it is a little bit overvalued at the minute. Now, looking at the Costco versus the S&P 500. Over the last 5 years, it has smashed the market up about 200%, even in the shorter time frames as well. With this recent drop-off, still up 33% compared to the market's 11%. So Costco has historically been a buy. It's always been overvalued in terms of sort of the traditional metrics, but you can see it does keep on growing now. Is this the right time to buy? I would probably wait, but then again, that's me. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check my Patreon. I'll catch you guys next time.